and welcome to the Ethics of Excessive Risk-Taking. This PowerPoint is by myself, Matthew McInerney, Freddie Gill, Dante Porter, and Nassim Rahman. Today we'll be going through the ethics of excessive risk-taking, identifiers, examples such as the dot-com bubble, Barings Bank, and the 2008 financial crisis, the effect this has on the industry, moral hazards in handling, and we'll wrap this all up in the conclusion. So what is excessive risk-taking? Excessive risk-taking is the behavior of institutions or individuals that are partaking in financial actions or investments where the risks posed are disproportionately large compared to the benefits. So what are the ethics of this? Excessive risk-taking isn't inherently illegal. However, actions that it leads to can drift into illegal activity. This could be in the form of actions such as negligence or market manipulation. This is why risk-taking is such a controversial and important topic, as it is more subjective than other issues, and what some deem as fine, others would see as overextending into the illegal side of economics. This is the ethical decision-making model used by the Home Office, and we can use this in the economic sector to process decisions. So what are the identifiers? A short-term focus where the individual or institution puts more focus on immediate gains rather than long-term growth. The second is speculative investments. This is where investments are made based on speculation rather than objective data and information. The third is poor risk assessment, where failing to assess the potential impact of the outcomes or actions taken. And fourth is the lack of diversification. A focus on only one sector can lead to huge losses due to the vulnerability posed.
So what are some examples of excessive risk-taking? We have the 2008 financial crisis, where financial institutions invested heavily in assets in the form of subprime mortgages. We have Barings Bank, which we'll get into later, a banking firm who failed after a series of risky trades. And the dot-com bubble, a stock market bubble caused by speculation in internet businesses. The dot-com bubble. In the mid-1990s, the technological and communications sector seen rapid growth. This growth influenced many investors into pouring money into the startups of the sector. They did this blindly and without planning a balanced and efficient investment model. As a result, dot-com companies were greatly overvalued, and this was realized in the turn of the 2000s. More and more investors started to pull out their investments, which led to a prolonged decline in stock prices, or better said, a bear market. The companies ended up becoming bankrupt, and investors suffered large losses. The dot-com bubble had a large effect in the economic sector. This is shown in a significant drop in the FTSE share index, where you can see it dropped from just over 3,000 to below 2,000 in the turn of the 2000s. This crash affected other sectors due to widespread fears, leading to investors to sell off equities in other sectors. So how does excessive risk-taking affect the industry? It can have huge implications within the industry, such as the share collapse due to the dot-com bubble burst. It can also create a lack of consumer confidence, market irregularities, and as we'll discuss next, businesses filing for bankruptcy. The whole industry can suffer from the risks taken by companies, groups, and individuals. This is why it's important to look at the ethics of these actions and how we can avoid them in the future.
The Barings Bank collapse. The Barings Bank collapse in 1995 was one of the most infamous financial collapses in history, as it led to the bankruptcy of one of the oldest and most prestigious banks in the world at the time, Barings Bank. At the time of its collapse, it was 230 years old and also had the Queen as one of its clients. The scandal happened due to one unauthorized trader who went by the name of Nick Leeson. His individual positions in the market cost the company over 800 million, which at the time was more than the bank's total capital. So what happened? Leeson was unauthorized trading for up to 2 years before the collapse of the bank. However, it was only losses from December 1994 onwards, which was enough to cause the ultimate bankruptcy of the bank. Between December to February, his losses grew almost threefold, from 250 million to over 800 million by late February 1995. This is partially caused by the earthquake which hit Kobe, Japan in 1995 in January, as he had a lot of money in the Asian market, and the Nikkei went tumbling down as the earthquake hit Japan. The cost of closing all of his positions was around 927 million, which he'd hidden from the company in an account named 88888 error account, which he'd created to hide his losses from the company under the guise of accounting issues. He was arrested in Frankfurt Airport as he tried to flee Singapore, as he tried to get back to London, and he was sentenced to 6 years in prison. However, he only served 4 of them. He has since left prison and moved to Galway Island and wrote a best-selling book. But the aftermath was Barings Bank was declared bankrupt and sold to the Dutch investment firm ING for only £1. Their shareholders were left with nothing, and 1,200 people in Singapore lost their jobs. The Barings Bank scandal was a clear demonstration of the consequences of poor governance when reliance is just left to an individual and there's a lack of oversight from bosses and the employers. The collapse was not just a result of one trader, but a accumulation of systematic failures within Barings Bank, which allowed this to happen from oversight.
So in this section, we are going to discuss a little bit about moral hazards and how they play a role in the ethics of excessive risk-taking. So what is a moral hazard? A moral hazard is when a financial entity partakes in unnecessary high-risk strategical financial decisions with the expectation of returning large financial gains. However, they take these risks knowing that someone else bears the costs should the risks fail. How does this cause excessive risk-taking? Essentially, the moral hazard is that financial institutions are provided protection should their strategies fail. This is because if any financial institution fails, it can cause systemic risk, which is essentially a knock-on effect to the rest of the economy. As a result, the government will have to provide financial aid to bear the cost of failed strategies and reduce systemic risk. How can regulating authorities handle the issues which have been outlined in the presentation? The primary way of handling these issues is through regulation. A previous example of regulation which is aimed to target excessive risk-taking would be the Dodd-Frank Act. This was an objective measure that was put into place to help avoid the rapid spirals which could be caused by institutions failing, such as the bankruptcy of Barings Bank, which we touched upon. Another way would be to attempt to change the culture within the financial sector. This could be done through training and education of employees to further diversify their investment assets, essentially to make sure they don't put all their eggs in one basket. The problem with this type of regulation is it is much more subjective and the teachings may be bent slightly or even ignored. And in any extreme cases like the 2008 financial crash, crisis management could be put into place. These would have the aim of lowering the effects if risk goes too far and somewhat soften the resulting blow. However, this type of regulation is not preferable. In conclusion, overall, the ethics of excessive risk-taking drifts into the subjective viewpoints of individuals. However, what we can see are the effects of when risk-taking is out of control, such as in the case of Barings Bank, and the effect on not only the economic sector, but other sectors as well. This is why it's important we monitor and constantly improve the safety of investment options. Thank you for listening to our PowerPoint.